Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. Last week was quite significant for the currency markets and maybe even for the short term trend in dollar. ECB left interest rates unchanged and cut both inflation and growth forecasts. Friday's job data from the US pushed risk assets higher, even though the non farm payroll was higher than both the previous figure and the expected figure. There are some details which JK will cover. Essentially, euro started trading higher than 1.09, gold at 2187 and almost a 1.6% rally in the sterling last week. Good morning, JK. I'm sure you have lots to cover. Take our viewers through what changed and what will grab your attention this week.
Good morning, Swaraj. Yes, we had very important, economic indicators last week, and also the policy meeting. Apart from Powell's own, testimony, all of them were, on the focus. But definitely, the two events on Thursday were very, significant. The ECB left rates unchanged. That was not a surprise at all. But they also indicated the economy is weak, and despite that, there will be no rate cut happening ahead of June. Now, most market men, as well as the majority of the ECB policymakers, are veering to June rate cut, but there can be a series of 3 to 4 rate cuts starting in June. So that's the important thing that's happening as far as the Eurozone policy is concerned. But at the same time, we've been talking about, Eurozone showing some signs of recovery. We had further evidence on, Thursday when the industrial production in Germany jumped, to 1% month on month, marking the first expansion in 9 months. So while economy has been weak, as Lagarde says, but there are signs actually that the Eurozone is recovering. So the rate cut from ECB, a series of rate cuts happening from June onwards, will be a definite big boost to the growth in Europe. So that is the reason why Euro has got a very good support. Now, coming to the US, situation, almost all the indicators leading to US employment situation were weak last week, as we have shared on, throughout the week. The JOLTS data showed lower jobs availability and quits rate actually dropping. ADP payrolls showed less than expected at 140,000 versus 150,000. ISM services survey showed employment swung into contraction territory at 48. Challenger report showed layoffs at the highest level since the financial crisis at 84,638. So all this thing finally was confirmed in the non-farm payrolls, while the higher number for the month of February than forecast at 275,000 was impressive. We had seen substantial reduction, or rather revision, in the numbers for January as well as December, bringing down the average employment creation for the last 3 months to 167,000. See, we have been reading headlines of 300,000 plus, 200,000 plus, and all. But if you look at the average of the last 3 months, it's only 167,000. That's quite modest. Now, important part is unemployment rate also went up from 3.7% to 3.9%. It has been hovering around 3.7% for quite some time. And finally, the factor which would eventually move Fed outlook for rates is the wage inflation, month on month, dropping from 0.5% in January to 0.1% in February, and the year on year dropping from 4.4% to 4.3%. So all this, more unemployment rate indicates economy is slowing, particularly if it persists higher level, and it would necessitate a rate cut sooner rather than later from Fed. Of course, market expectations have not changed. They remain at around 72% for June. And the key here is wage growth, which if continues to fall, I think I won't be surprised that they go for a sooner rate cut. But for that, we'll have to wait. And we also have important CPI number for the month of February that's coming up in this week, rather tomorrow itself, where again we have a drop in the core number, but the headline number shows that month on month there is an increase. But overall, the number is still hovering well above 3%, and whether Fed is going to give credence to that or to growth that is showing some slowdown is what deciding the course of the US rate cuts. So we still have some time to look at what's likely. We also had some developments, as far as Japan is concerned. Japan economy awarded a recession 1 week before BOJ meeting. BOJ is meeting on 19th of this month for a policy decision. And this has reversed the quarterly contraction that was announced in the earlier estimate. So that's a good development. And also, we have the wage negotiations in Japan, which are indicating that they are going to be substantially higher. And now we have actually indications from both the BOJ chief Ueda as well as another member, which is matching, saying that Japan will be close to hitting the inflation target, and therefore there will not be a surprise if they go in for a policy change. I mean, moving away from negative interest rate policy in the current meeting itself. At least the market actions so far, a substantial fall in the Nikkei index, and then the Japanese yen moving below 147. All these are indicative that perhaps the market expectation of a rate change or the policy change from Japan may not be too much off the mark as of now. We did have some development in China as well. We saw a strong recovery in their trade number, leading to a surplus of 125 billion in the first 2 months of this year. Exports, made a good jump of around 8%, and imports were, of course, also higher, but that was only around 3.5%. So that's a good development as far as China is concerned, but consistency is the key here. China consumer prices also rebounded in February thanks to holiday-driven consumption. It jumped 0.7%. However, the PPA number, which measures the cost of goods at factory gate, was down 2.7%. Again, it's a mixed picture. China, there are some things which are seeming to be improving, but consistency, is what the market will be looking at. Chinese government also announced strong measures to improve the housing sector. We really have to wait and see whether that really works for them, because most of the housing companies, or rather housing finance companies, have huge debt, and how that will be addressed is the biggest problem as far as China is concerned. And of course, overall, their relation with the US, which has a big question mark, even as the US goes into polls, and who will be holding the reins in US for the next 4 years will decide how the relation will go. So there's a lot to still happen for China to get the market's confidence in. But yes, the authorities are managing to keep the yuan from falling further, and also the stock market has been somewhat holding up. Now, if you look at the market actions, despite the weak employment numbers in US, yields have not moved that much. US fell about 6 basis points, while 10 years by about 11 basis points. These look very modest if you look at the rises and the fall that we have seen over the last few months. Now, stocks also fell after a strong run, and broad weaker jobs data confirmed that Fed may be cutting rates in June, if not earlier. Both S&P 500 and Nasdaq showed a bearish engulfing pattern, which means we have some more downside in the sessions ahead. But for me, possibilities of a change in Japanese policy is what is driving the markets, or overall equity markets lower. We have downside in Japan, we have downside in Australia, and the Asian markets as well. All of this, I think, has something to do with the carry trade unwind due to the possibilities of policy change in Japan. Now, finally, just to mention something on the euro, euro is definitely carrying a positive bias. Just to give you a perspective, even when the eurozone data was coming very weak, we had euro very well holding up above 1.07. Now, even without any new positive trigger, ECB mentioning economy weak, rate cut, series of rate cuts possible from June, euro actually has been very well supported. We had a very small retracement after the ECB rate decision, but it has gone above 1.0950 after the non-farm payroll report. In fact, to give you another interesting point, the Eurozone, rather the German bond interest yield actually fell much more than the US. I think both 10-year and 2-year fell around 15 basis points between Thursday and Friday. But despite that, we are seeing euro trading at almost at the multi-month high. So we are seeing very positive bias for the euro, which is actually pushing the dollar index down as well. Of course, the Japanese yen strength has also added momentum to the dollar index falling. Finally, on the rupee, we saw a 6-month low in the USD INR, although at 82.73 on Thursday. But then since then, we have seen it being well supported at 82.70. Perhaps the central bank has been active in the offshore market as well, or the market is a bit cautious of pushing it without seeing further flows. Flows have been very strong as for India, so that should keep the pressure on the downside. But how far it goes depends on the central bank. Upside is well capped at 83 now. If the central bank loosens its grip, we will not be surprised to see a fall towards 80 to 50 and beyond in the coming weeks and months. Thank you.
Thank you, JK. And just quickly summarizing, for ECB, they kept the rates unchanged, indicated that the economy is weak, and majority of the ECB members seem to be keen on a June rate cut. There seems to be, however, some economic recovery going on, so how that will play out will also matter. For the US, almost all indicators for the employment situation seems to be weak. Even though non-farm payrolls was higher was a higher number for February, there was substantial revision in the previous numbers. Unemployment rate also ticked up from 3.7% to 3.9%. And we also saw some drop in wage inflation in February. For rupee, we hit a 6-month low in the USD INR pair, 82.73 on Thursday, seems to be well supported around 82.70, and central bank action will matter around these levels. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.